Hi everyone, and welcome to the third lecture of our seminar series, The Economics of Post-Crisis Recoveries. My name is Ellison. I'm the director of OUBEP. It's great to have so many of you joining us today. Thank you for taking the time. I also want to say a big thank you to our sponsors for this series, Jason & Co, and particularly their Chief Investment Officer, Chris Rosbach, who we had a great conversation with 2 weeks ago with an economist here in Oxford on the short and long-term impact of COVID on the economy and more broadly the society. We are going to share the video of this conversation next week on our website and social channels. There are some great insights, so I highly recommend that you take a look and take part in the conversation if you will. Quick bit of housekeeping, all participants are on mute. Please use the Q&A function to ask questions, and I will pause throughout the sessions to pass them on to Martin. We've only got 1 hour, so if we don't get to your questions, apologies in advance, but email us, connect with us on LinkedIn or Twitter, and we can carry on the conversation there afterwards. So today we're going to talk about fiscal policy and the national debt going forward. Quite timely, as it was announced this morning that the government borrowed 19.1 billion in February, the highest figure for that month since record began in 1993. So I'm sure Martin will have a view on whether or not that's a big problem or not, maybe, and hopefully we'll have the answer at the end of this lecture. So I'm delighted to introduce Martin Ellison, Professor of Economics at the University of Oxford, a fellow at Nuffield College. He was previously a consultant for the Bank of England and is currently a consultant at the European Central Bank, a member of the Finnish Economic Policy Council, and a fellow of the Centre of Economic Policy Research. His research interests cover many areas of theoretical and applied macroeconomics, with recent papers concentrating on the management of the UK national debt, the role that leaving the gold standard played in the Great Depression, and the economic value of increases in longevity. It also contributed to a recently published volume of readings by the IMF called The Debt and Entanglement Between the Wars, and is published in many economic journals. So I will leave you in his expert hands. Thanks, Martin. Over to you.
Thank you very much, Heloise. It's very nice to be here and very nice to share this lunchtime date with so many people. In response to Heloise's question of 19.2 billion, is that a good idea? I might have said no, but I'm due to get my vaccination tomorrow, so I think that's probably a bargain on my own personal point of view. Okay, today I'm going to structure my talk around 4 different questions. It's going to start with what has happened. And then I'm going to go to a historical sweep to say, well, can we take any precedence for what has happened now from what has happened in the past? In the third section, I'm going to change gear and start to give you opinions about what should be happening now. I'll be drawing on work of economists and some of my colleagues. Having put those in place, I'll conclude with my view of what is likely to happen. And you'll no doubt be quite interested to know how 3 and 4 meet. That is what is likely to happen, what we think should be happening. Let's start with a discussion of what has happened. Well, you don't need a professor of economics in Oxford to tell you we've had a bit of a crisis. We're in the middle of a pandemic. That pandemic has had significant effects on public finances. Not surprisingly, government tax receipts have been falling, and simultaneously, government spending has been increasing. That's going to lead to a big deficit on the government account. To put that in context of the last 100 years, here's a plot which shows in yellow government tax receipts as a proportion of GDP, and in blue government spending as a proportion of GDP. Looking first at the tax receipts, the yellow line, you could see that's hovered around about 40% of GDP since the end of World War II. It doesn't vary that much. Even in the pandemic, where you can see to the far right, it's staying roughly at about 40%. Now, of course, that's in part because GDP itself has fallen, but relative to GDP, it's quite stable. Looking at the blue line, spending, you can see that's much more dramatic fluctuations. On the left, you've got big increases in spending in World War I and World War II. And then in the right-hand side, you've got in spending increases in 2009, 2010, the financial crisis, and now in 2020, 2021, when we have the COVID-21 pandemic. So the big things that leap out at you here are wars and financial crises, and now the coronavirus crisis. Let's look in a little bit more detail at what's happened over the last year. Start on the left-hand side of this chart. Before the pandemic started in March 2020, the forecast was that government borrowing would be about 50 billion. 50 billion is about 3% of UK GDP. But then the pandemic hit, and that causes all sorts of trouble for the government budget. First up is the big red bar, which is receipts. The economy goes into lockdown, people are laid off, a lot of economic activity doesn't take place. So income tax receipts go down, national insurance receipts go down, VAT receipts go down. The government brought in on all those taxes roughly 100 billion less than what it was expecting for 2020-21. Next move up to welfare spending, almost no change there. There's a little bit of a red extra spending concurrent with the uptick in universal credit, but that's really quite small. Debt interest spending actually fell slightly as interest rates were lower than expected, and there was very small changes in other spending. Now we come to the next big red bar. That's public services. That's really health. 100 billion extra spending on health. You'll have seen this in the news. This is getting hold of PPE. It's the test and trace system. It's investments in vaccines. Two more big ones. Next one is support for households. So this is the coronavirus job retention scheme, the self-employed retention scheme. These are the furlough payments that's helping to pay wages. That's coming in at some 70 billion. And then finally, the last big expenditure is grants to businesses, business support, things like business rates holidays. Add all that up, and you've got the very far blue bar that instead of borrowing 50 billion, the government is borrowing 350 billion, an extra 15% of GDP. Not surprisingly, if you borrow an extra 15% of GDP, you lead to a big increase in the public sector debt. This chart shows you that debt to GDP in the UK was hovering around 80% from 2016 through to 2019, 2020, and was expected to very mildly drift below the 80% level up to 2025. But then the pandemic arrived and there's a big jump up. The yellow line shows you the situation that was forecast in November 2020. That's slightly improved by March 2021 in the blue line, but you can see almost a 20 percentage points increase in the debt to GDP level. No great surprises there. A big increase in the national debt, about a third of which is coming because of lack of government tax receipts, and about 2/3 is coming for various support schemes and spending on health during the pandemic. That public sector debt at 100% of GDP, let's have a look at how it is composed. This chart is showing you the maturity of that debt. So let's go to the far right-hand side, which is the most interesting. Go to 2020. The black horizontal line there is the start of the pandemic. You've got a big proportion of the debt is coloured in green. That is the proportion of the debt that only needs to be repaid in at least 15 years' time. So more than 40% of that debt is actually tied up and doesn't need to be repaid for at least 15 years. The next chunk is the purple chunk, which is 8 to 15 years. So really, there's only about 1/3 of the national debt that needs to be repaid in the next 8 years. I'm going to use that as an argument for not being overly concerned about this national debt. Because it's tied up for such a long time, we have time to wait. We can work on the supply side of the economy and then worry about repaying that debt. It's important too to look at who owns that national debt. Here's a breakdown of the 2 trillion that we owe by different institutions. So about 1/3 is owned by you, essentially. It's owned by your pension fund that you've contributed to and insurance companies that you may be holding your insurance policies with. About 1/3 of it is held overseas, and about 1/3 is held by the Bank of England under their asset purchase facility. Remember QE2, QE1, the quantitative easing programs, those things are essentially sitting as reserves in the Bank of England now, and they are owned essentially by, you can think of financial institutions. There's then a smattering of the debt held by other financial institutions, monetary financial institutions. What I want you to take home from here is that 3/4 of the debt is essentially held domestically. It's held by citizens of the United Kingdom. That's going to be important when we think about how we should address the size of the debt. Let me finish up this section on what has happened by giving you some data on the very latest government borrowing. Here is some information about debt that the government issued on the 16th of March, so just 3 days ago. So it raised 1.6 billion with gilts that were set to mature in 33 years. The way this works, the government offers that we would like to borrow and we would like to pay back in 33 years. We will pay you coupon payments during those 33 years. What price would you like to bid for those gilts? The price is then determined in the market. That price was 1.3%. So the government was able to borrow at an interest rate of 1.3% for 33 years. So pretty low interest rate there. The bid to cover ratio is how many bids they had relative to the amount they wanted to sell, and it's 2.1. So this suggests that the government can borrow at low interest rate, and there is quite considerable demand from financial markets to make that lending. The government also borrowed at 3-year maturity of 4.4 billion. It was able to borrow at 0.2%. So again, very low interest rate and a bid to cover ratio of 2.5. There was a lot of interest in that debt issuance. Finally, the government also issued index-linked gilts. So these are ones that are protected from inflation by the return being linked to CPI or some other inflation measure. Those similarly proved popular, perhaps because people think there's going to be inflation, or perhaps because they are more worried about inflation uncertainty. And the yield to maturity on those actually was negative, minus 2.6%. So if you think that they are expecting about 2.5, 2.6%, they're essentially demanding a zero real return. We can generalize those prices to the whole of the yield curve, which is what I'm doing here. On the left, showing you the nominal forward curve. So this is like the first two of those gilts that were issued, the 33-year gilt and the 3-year gilt. And you could see at all horizons ahead, the nominal interest rate is pretty low. 40 years out, it's about 1%. A little bit more for intermediate and very, very low for the short maturities. So interest rates are low. We can use the difference between what people were prepared to pay for the standard non-index gilt and the index gilt to work out what people must be expecting about inflation. That's what the middle chart here is showing inflation expected to be about 2.5% to 3% over the next 40 years, all the way out. I suspect that's a little bit overstating. Those gilts that are index linked are not quite as liquid as the ones that are not index linked, and so there may be a little bit of a liquidity premium out there. This may slightly overstate inflation expectations, but let's live with that at about 2.5% inflation expectations all the way out 40 years hence. That, of course, on the right-hand side means that the real curve is very, very negative. The markets are paying the government to borrow money from them in real terms. Quite a remarkable situation to be in. I'll pause there and see whether there are any comments or questions.
There are a couple of questions, Martin, already, yes. So do you have any indication of the debt percentage GDP, compared to GDP in the UK compared to other economies in the West particularly?
Yes.
How do we compare?
I think we've got a little bit of that world-beating flavour. Now we're a little bit higher. As I said, I'm on the Finnish Economic Policy Council. Yeah. So Finland is very worried that the debt to GDP is getting above 60%. But of course, if you look at Greece and Italy, then we do look quite good. I don't have the precise figures on my fingertips, but we're higher than many countries that I would prefer us not to be higher than. But we're lower than countries which I'm very relieved that we are lower than.
Okay, that's a good answer. And then the second one is, if the inflation is to come back, given the massive increases in government debt, is the government hamstrung in its ability to raise interest rates to control the inflation, or is inflation desirable to erode the debt?
So I'm going to postpone that one a little bit, because I think inflation is a bit desirable to repay the debt, but I think that's a limited possibility because of what will happen to nominal rates. And I'm worried that if inflation goes up, nominal rates go up as well, and so we're back to square one.
Okay, I'll let you carry on, and thank you, Martin.
Thank you for those questions. This is good because I feel like I'm in some cavern here and there's nobody there listening, or there's nobody talking. I'm shouting at clouds here. And
no, there are people online, definitely.
That's good. Maybe there should be a cheer button or something. Or like in Facebook, you could put a love heart, and a love heart would appear on my screen. Right, what happened before? I'm getting older, so I get interested in economic history. And this has been motivating quite a lot of my research over the last few years. So I want to take you back to 1694. King William III, he needs money because he wants to go to war. 9-year war is going on. And he needs cash to pay for his soldiers and whatever you need to go to war. And so he decides to raise money from a syndicate of merchants. There's the picture of King William III surrounded by his merchants. And so he borrows £1.2 million at an 8% interest rate. This arrangement eventually became the Bank of England. It was quite good. He won the war, although then he ended up in more wars afterwards. But it became the Bank of England. And I want you to kind of bear in mind, think of what's happening here, that the king, on behalf of all the subjects in the kingdom, which of course us, is borrowing money from a selected group of people in the kingdom, and he's going to use tax revenues to repay that money. Incidentally, that original loan of 1.2 million, it was repaid 300 years later, in 1994. So they kept on paying the coupon payments. The 8% payments were paid, but it was not repaid until 1994. Having established that precedent in 1694, we've then used debt to fund a whole host of things over time. Here's a plot of the size of the debt to GDP from 1694 onwards. So right at the very left-hand side, there's that very first King William III borrowing. Debt was rising up until the end of the Napoleonic Wars in 1815. UK has a remarkable taste for war, and there's just one after the other, and the king is borrowing more and more money to pay for those wars up until 1815. In 1815, at its top, the debt to GDP was about 200%. We then had a long period of peacetime falling to the start of World War I, in which debt to GDP ratio fell by more than 100 percentage points. We then had World War I, where debt again picked up. Many of you will know about war bonds, and the country needs you, wanting you to invest your savings in war bonds. We also borrowed heavily from the US. So there's two lines here. The solid line is the borrowing we did in the market. The dashed line involves all sorts of borrowing we did internationally. Also, if you have national savings certificates, premium bonds, all those borrowing we did not through the market. After World War II, we then have a fall of about 100 basis points in the debt to GDP ratio, this time over about 50 years. So I want to talk to you about those two long periods when we repaid the debt, because we can learn lessons for those. One, how we are able to repay the debt, and two, what that might imply for what we're doing now. I've added on the very far right the latest estimates of the debt. The black line there you can see was rising with the financial crisis, and the very far right in red is what we've done through coronavirus borrowing. So we'll get a bit more on there following Heloise's point about an extra 19 billion. But within the context of this picture, that debt to GDP level doesn't look too bad. It's nowhere near the levels that we saw at the end of the Napoleonic Wars, and it's nowhere near the level we saw at the end of World War II. Let's then turn to these two periods where the debt to GDP level was falling dramatically. So how can we get the debt to GDP ratio to fall? Right, we're all amateur epidemiologists now. We all know about R number for diseases and how important it is to get the R number for diseases less than 1, and then we eradicate the virus. So we can think the same way about an R number for the debt to GDP ratio. If we can get the R less than 1, then the debt to GDP ratio will fall. Whereas if the R is above 1, it's going to rise. This R for the debt to GDP ratio is going to depend on 4 things. It's a ratio, so some of these will affect debt, the numerator, and some of these will affect GDP, the denominator. First up, the budget balance. Is the government getting more in tax revenue than it's spending, or is it actually spending more than it's getting in tax revenue? That's going to feed directly into debt. So the most recent tax year, 2021, we saw that the government is spending a lot more than tax revenue. That's going to be a budget deficit. That's going to feed directly into debt. Similarly, you have to pay interest payments on the debt. You have to pay for coupons. That is going to do the same thing. It's going to increase the debt. But you can reduce the GDP ratio, debt to GDP ratio, by working on the denominator. If you get nominal GDP to increase, then even if nothing's happened to debt itself, it becomes smaller relative to the size of the economy. So we could have real GDP growth, or we could have inflation. In terms of the R number, if I'm imagining I'm in the Downing Street press briefing room before the pandemic, and somebody goes, "What's the R number for debt?" It's probably less than 1, but not much less than 1. So we were on a world where the debt to GDP ratio was falling before the pandemic. Let's have a look then at those 2 big falls in the debt to GDP ratio. Start with what happened after the Napoleonic Wars and all those wars that came before then, before we got to the end. So 1816, end of the Napoleonic Wars, debt to GDP is just shy of 120%. By 1913, so before the outbreak of World War I, that had fallen to 16%. So almost 100% fall in the debt to GDP ratio. What was driving that? Well, looking at the data, the first big contribution is from budget balance. The government ran surpluses between 1816 to 1913. And so that reduced the size of the debt by about 3% every year by running a surplus. One of the things that caused the surplus was, of course, the introduction of income tax. That was a new invention after the Napoleonic War. So running surpluses pulled down the debt. Interest payments, of course, still had to be made, and they pushed up the debt. Looking at those first 2 numbers, though, they're roughly in balance, that the government ran a big enough surplus that it was able to fund the interest payments on debt, and they kind of offset each other. The country did grow, and so GDP growth is reducing the debt to GDP ratio. Actually, there was not inflation, but there was deflation in this period. So the inflation, which was deflation, actually caused the debt to GDP ratio to go up rather than go down. But put all those together, the denominator grows, the numerator doesn't grow, and you end up with debt to GDP falling by about 1% a year. The motivation for this is what was called the English method of war finance. The thinking was that the costs of war should be borne by the current generation and not passed on to future generations. That later became what was known as the McKenna Rule in 1915. What about the other one? Paying off World War I and paying off World War II. Same exercise, 1947, debt to GDP ratio is 127%. Over the next 50 years or so, it fell to 18%. So again, a 100 percentage points fall in the debt to GDP ratio. The story here, though, is very, very different. Budget balance, no surpluses here. If anything, the budget was slightly in deficit. This was a change in mentality. We launched the welfare state, we introduced a lot more state spending, we liked to spend, we raised taxes to fund those, but we were left not running any surpluses. If anything, there was a slight increase in the debt to GDP ratio because of the budget deficits. Interest payments still had to be made, so the debt is rising in absolute terms throughout this period. Growth, again, was good. It contributed to reducing the debt to GDP ratio. We had a post-war boom, in essence, so that reduced by 1.7%. But the big thing here is we had inflation. Inflation was sufficient to reduce, on average, the debt to GDP ratio by 2.7%. Many of you will be remembering the sort of inflation we had in the 1980s, where we got to double-digit inflation. So the story here is the interest rate was quite low, but inflation was quite high. Which sounds great. Excellent way to repay the debt. We inflate it away. Well, that's all right, as long as you can keep those interest rates low. And it's true that paying off the World War I and World War II debt was largely achieved by savers receiving poor returns on their savings. But how can the government ensure you get poor returns on your savings? Well, what the government did is they forced very high reserve requirements on banks. So they said, look, you have to keep a lot of your deposits in gilts. So they forced banks to hold gilts. They then said, well, if you lend to some private company, you can only charge a certain amount of interest rate. So there was a cap on bank lending rates. Now, if you're a bank and you said, well, if you lend it to some company, you can only get a poor interest rate, that makes you more willing to save with the government. So there's lots of restrictions domestically stopping returns on savings getting high. Furthermore, because we're in the Bretton Woods exchange rates regime and we have capital controls, the domestic savers, they didn't have access to better interest rates abroad. They were forced to save domestically in banks, which were pretty much forced to hold government debt. So you put all that together, you are forced as people to lend to the government. We call this financial repression. Not necessarily aimed at reducing the debt, but it certainly helped. That was the story for how we repaid the debt after World War II. I'm skeptical that we can do this again. Is it really possible that we can put such limits on the domestic financial markets that we can keep the interest rate well below the inflation rate? And is it possible we can stop people moving their money abroad to take advantage of better interest rates that are not subject to this financial repression? I have my doubts. Over to you, Heloise.
Sorry, just going back to the question. So yes, we have, and do we have a sense of how the different factors influencing your R number are connected? So for instance, a hugely unbalanced budget could raise a risk premium and in turn increase in the interest payments. Are we hitting some tipping points, for example, with the current huge increase in debt?
So, good question. I think not. So, as you saw from the graph, we have had 200% debt to GDP ratios, and we're now at 100. I also think it's a very different situation. So if you think post-war, there's a lot of uncertainty out there as to what the post-war economy is like. Now, it's true, there's some uncertainty out there now about, are we going to go back to the office or not? Or is there going to be change? To me, that seems a whole order of magnitude less than the uncertainty of what is going to happen when all these people are demobbed and come into the economy. So while I see the argument, I see the uncertainty, and I'm not too worried. As we saw from those yield curve estimates, financial markets don't seem to be too worried about tipping points. I think, if anything, the relationship is linear. As you get more debt, the interest rate gets steadily worse. But it's not like that discussion we had some years ago where you're fine until you get to 90 and then all hell breaks loose after 90.
Okay, thank you. And there's one question from Simon. Do you know how much of the national debt overseas portion that you talked about is held by China specifically? Do we have those numbers in top of your fingertips?
I don't have them. That's embarrassing. It's less than a quarter because the whole quarter is owned. I'm going to look that up as soon as I get to the end of the lecture. So
okay, and then we'll come back to Simon and maybe over email or LinkedIn next week. Brilliant. Thanks, Martin. Carry on.
Thank you. What should happen now? Important to remember here is that the national debt is not the nation's debt. Go back to that idea of the founding of the Bank of England. It's the king borrowing from some UK citizens. Keynes understood this. He understood lots of things, particularly understood this. National debt is not a question of the amount of the national wealth, but solely of its distribution. The fact that the UK has got debt of 100% of GDP does not in any way tell you whether we are a rich or a poor country. It's completely irrelevant, bar that stuff that's held abroad. As Keynes put it, we should not be a penny the richer either for waging war or for social reform if we had practically no internal debt. So, putting my slightly lefty hat on, don't tell me that we can't have school dinners free for children because of the size of the national debt. Those are not two things that are connected. We could pretty much cancel all the national debt and we would have just the same amount of resources available. Final quote from Keynes is simply a question of distribution of the current national income between individuals and of the tax instrument as a factor in modifying this distribution. So at the moment, you've got a whole set of taxpayers transferring resources now to the bond holders, to the gilt holders. But it's a transfer within the United Kingdom. It's a transfer of our national wealth between ourselves. It's not wealth in itself. I'm stressing that important because it feeds in to the question of what time frame we should take to repay this national debt, if ever. Economists have been thinking about this for a long time, and as ever, there's always economists who have got different views, and then we talk and we discuss and we find out we don't have that different views, we come up with a compromise and we go forward. So the basic argument was between Pigou and Keynes. So Pigou said, look, you've got this situation where money is being transferred from a lot of people, the taxpayers, to a small group of gilt holders. That's a big distortion in the distribution. It's treating people differently. There's inequality. We should pay the debt down quickly so we remove that distortion between the distribution within the current people alive. Keynes said, no, I'm not having that. What we can do is we can keep the debt and let it be repaid in the future when it'll be less of a burden. Look, people are going to be richer in the future. They're going to be better off. So they'll be better placed to repay the debt than we are currently now. So let's repay into the future. If you like, Pigou is worried about the distortions that happen now between those who are taxpayers and those who are gilt holders. Keynes is worried about distortions between people alive today and people alive in the future. If you see that second distortion more important, then you will actually go for a slower repayment. We distill that down to modern thinking on the national debt, and the chap most associated with this is Robert Barrow, and pretty much economists sign up to this. The basic idea is that debt should act as a buffer. If you have shocks, say to spending or in tax, you should let debt react to those shocks. It should absorb swings in the deficit. Some of you may have read the little note I circulated before this talk, where I talked about the debt vaccine. I think national debt is a really great thing. This means that we can insure ourselves against things like coronavirus shock. This is absolutely what we should be using debt for. We have a terrible shock, which is potential to cause huge damage to our economy. This is the time to let debt take the strain. What you should do is look at that third equation, tells you how debt evolves. You set taxes at the right level to give you long-run solvency. You decide how much you want to spend, usually. You set the right amount of taxes to fund that, but then you keep the taxes the same, let the government spending move for various crises, and let debt take the strain. What this means is that debt is going to be a very slow-moving variable. So when the pandemic hits, there's going to be a big increase in debt, use it as a buffer, and then it should be very, very slowly coming back down. It should be the most persistent, the most swinging variable that you see in macroeconomics, which means there should be a time frame of decades in response to big shocks. Coronavirus shock hits, it's a 1 in 50 year shock, 1 in 100 years. We should be thinking about 50 years time to repay that debt. Just like you saw after the Napoleonic Wars and after you saw the World War II, it's going to take time, and that's the right thing to do. Taking Barrow's argument a little bit further, if you take his purest form, then you never plan to repay the debt. I think most economists wouldn't go that far. The key thing that Barrow is there assuming relates to the question that just came up, that if the debt rises, does that push up the interest rate? And Barrow is thinking, no. If you think yes, then that takes a little bit of the sting out of Barrow's argument, and you should indeed plan to repay the debt, but not very quickly. So perhaps debt shouldn't be just a random walk, but it's very, very slow mean reverting. And there are various extra arguments we can put on the table to further strengthen that. So one that's always made is we need fiscal space for the next crisis. So maybe this was okay. We managed to borrow enough to cope with the coronavirus pandemic. We managed to about 20, 30% of GDP nicely to pay for the crisis. But what happens if there's another virus comes out in 5 years' time? Well, if we are only very, very slowly paying off the debt, we'll be starting that crisis from 110, and we may be going up to 130, and so on and so on. I don't think we really know whether this is a once in a 500 years crisis for health, but you can argue we need to make that fiscal space because otherwise we will be running into higher interest rates. Second argument is essentially the same, that maybe we will have trouble rolling over our debt, and that will push up interest rates in the future. Finally, maybe Keynes is kind of wrong, because we're in an aging society, and actually that burden is going to fall on a smaller group of people in the future, not a larger group of people. So it might be that those people in the future are actually worse off, and so we should be thinking of paying off our debt now rather than when they are alive. So that's a little bit of sort of extra spice for repaying more quickly. I think most economists would still say it should be very slow. This is not the time for a huge austerity drive to make sure we pay down the debts. It's the time for a plan that gently brings down the debt back to where it was. There are, of course, other arguments for not repaying. This is a very nice quote. A national debt, if it's not excessive, will be to us a national blessing. This is Hamilton, back in 1871, founder father of the US, and of course inspiration for Broadway musical, which I've heard is very, very good. He's talking about debt as a good, safe asset. So he sees like it's good to have this financial asset that is backed by the whole country. It's backed by the whole of taxpayers, because you can use it to store value. As a pension fund, it's very handy to have this very safe, very unrisky asset to put your assets in. People can use these as collateral for borrowing. You could, as a firm, you could put your holdings of treasury bills as collateral, and a general lubricant of business activity. Quite how much of that we should have, not clear, but some estimates I've got here about 67 to 145%. So it's not a good idea to pay down all the national debt anyway. Okay, it's time to see if people are still alive, or have they all fallen asleep?
I think they are, but we've got a couple of questions that I had sort of prepared, thanks to Peter in the background as well. Do you have a good understanding of what are the big events, those 1 in 100 years events that we talked about? I'm plugging in the conversation that we've had with Michael McMahon and Hamish Lowe and Chris Rothbach as well here, because that's something that came up from Michael, actually saying, we should repay that debt over 100 years. It feels like there are once in 100-year events every decade, almost the pandemic, the financial crisis, the Asian crisis. How should we take this type of uncertainty into account, if at all, do you think?
Yeah, so thank you. I'm going to go back to this picture. I can find it. You look at once in 100 years event, if you take that dash line, these look like wars, and this is a mild event by that consequence. And so, yes, these are 1 in 10 years or something, 1 in 20 years, I say. But the scale of the repaying of the debt is smaller appropriately. That you look at that little red tick there, and you go like, okay, that we can probably get it back down to where it was in 10 years. It's not it's not the 1 in 100 year event, I agree, but it's not the 1 in 100 year plan to repay the debt to GDP that we need.
Okay, and then you mentioned the optimal debt between 70 and 140%. So are we not getting into the tipping point that we talked about earlier?
Potentially, yes, but those are that 67 to 145. That's purely on the basis of thinking about this debt as its safe asset role. So there's nothing wrong with having more safe assets, if you like. It's not hugely a problem. I mean, yeah, there's a little bit, but it's not a tipping point problem. It's just kind of wasting money a bit by having too much of a good thing.
Okay.
Rather than, oh, this is going to cause lots of problems by having too much of it.
Okay, no, that makes sense. Thank you, Martin. I'll let you finish the last part because we're all keen to know what is likely to happen now.
What is likely to happen? Okay, thank you. So this is inevitably getting more my opinion rather than other people's opinion. It seems the markets think this is going to get sorted out, and I'm basing that on those bid to cover ratios. So when the government is trying to raise money, it's not that this is a thin auction where there's hardly anybody wanting to buy these things. They're oversubscribed by a factor of 2, by a factor of 3, and the price that's being paid is pretty low. So it doesn't look like there's some sort of default premium. It seems that financial markets think that things are going to get sorted. So given what we've just learned about the R and about how that is driven, it's got to be one of these things. It's got to be real GDP growth, it's got to be inflation, interest payments on debt, or it's got to be budget surpluses. One of those things has to work to make the debt to GDP come back down. So let's look at those in turn and see what we think of each idea. Let's start with real GDP growth. So real GDP growth, here is a plot over the last 40, 50, 60 years or so. We know that real GDP growth has been weak for quite a long time. It's been falling, as you can see on this graph, since about 1960. And so it's not looking good for this being a huge driver out of the debt to GDP problem. It'll help a bit, but it doesn't look like we're going to see a post-war boom where we saw growth rates of 4%, 5%, which really do bite and really help you to repay the debt. In part, I think that relates to what I was talking about, that this is very different to the post-war. Post-war, you're going to have a lot of investments as you rebuild the capital of the economy. You've got essentially bombed out cities that need to be rebuilt. There's a lot of scope to do things. Now we've got maybe empty retail premises and empty offices that are going to be moved a bit, but that doesn't seem the same size of task. So I wouldn't expect real GDP growth to be particularly strong and to really drive that. What about inflation? There's a lot of talk about inflation. As I said, from the data we have from financial markets, it seems they're expecting moderate inflation, and I think that's true, and that will gradually inflate away the debt. Especially in the UK, since we've got quite a lot of debt locked up in long maturities. Doesn't work with your index-linked debt because that is obviously index-linked. But as I already hinted earlier, I think if you do get inflation, higher inflation, that's likely to be driving up interest rates. So that might be the Bank of England reacting to the inflation and trying to get a lid on it, or it might be demands from savers that they want to be compensated for that inflation. So I can't see how we're going to get a big burst of inflation while keeping nominal interest rates low. That's what we would need to really get inflation to wipe out the debt. And as I said earlier on, it worked after World War II because of all that financial repression, because savings rates were artificially kept low by a whole set of restrictions on financial markets and the banking sector. It's hard to see that coming in. So I'm thinking more a gradual inflation eating away at the debt. What about the interest payments on the debt? This is a graph of the real interest rate, which is consistent with full employment. This is what we call R star. So this, you can think of just this as a real interest rate. And you could see that that's been dropping for a long time. Some people call this secular stagnation. One of the most popular stories here is an aging population with more demand for saving, and so that drives down savings rate. That will help a little bit, no doubt, that even if other things stay same, the real interest rate we're expecting to be quite low. But there's no silver bullet here. There's no financial repression going on. There's no real GDP growth. Which leads us to budget, whether that's going to be in surplus or in deficit. So let's have a quick look at what the government spends its money on. If we want to run a surplus, something here has to give. The big blue cheese at the bottom is healthcare. Really difficult to see that that's going to be falling in the near future. Preventative healthcare in particular, we would think would start to get more money. So if I have to pick one here, the red one looks to me the most vulnerable. Pension spending at 18%. We have the triple lock of pensions, which looks crazy in a world of very low inflation, to give them 2.5% guaranteed. Or then if we did have inflation rising to 3.5%, like financial markets are expecting, to allow pensioners to get that automatically, looks difficult to defend in a world where you're trying to create surpluses. So I think that one looks the most vulnerable. On the revenue side, the government has made very public its increasing corporation tax, but that's not going to do the job. At the end of the day, firms don't make much profits, so taxing their profits just doesn't bring much money in. We're left with income taxes, we're left with indirect taxes. I think maybe income taxes look more vulnerable than indirect taxes. Remember again what I said about William Pitt the Younger. We invented income taxes to pay off the Napoleonic War, so I wouldn't be surprised to see more things happening there. Personally, I think we should revisit wealth taxes. I think there is scope to do things there that would help to increase budget surpluses. Of course, what's likely is pretty much determined by political feasibility, and we're going to see a lot of St. Augustine here. Lord, make me chaste, but not yet. We are going to see politicians announcing all sorts of spending reduction plans and tax increase plans that will be somehow kicked into longer grass of being brought in a few years. And so I'm expecting to see quite a lot of this. Let's sum up. Take homes. I'm probably one of the few people who's quite happy about that government debt. I think the government should be an insurer of last resort, and the ability of the government to borrow on behalf of all the people it's a very useful policy tool. So I'm very happy that the government is an insurer of the last resort. That was one of the things I tried to push in the debt vaccine note I circulated. It's quite right to let the debt rise in response to the temporary shocks. So back to Heloise's first thing, it's fine. This is what we should be doing. There's a very nice piece just come out by the Resolution Foundation, spend fast, tax slow. We are in a pandemic. This economy is struggling and it's in trouble. Now is the time to use the power of government to borrow and to spend to help us all through this crisis. Temporary there is a key word. We have to make sure that the debt rises in response to temporary shocks, but conditional to that, I'm quite relaxed about the rising debt. We then will let the debt to GDP ratio gradually fall back, an R of 0.95 or something to get the thing back. And that's going to be achieved by mild GDP growth, mild inflation, and mild budget surpluses. I will finish there.